Ever feel like the stock market's like a giant casino, honestly? You're just placing bets and hoping for the best.
Right. It can feel that way sometimes.
Well, today, we're ditching the roulette wheel and
Yeah.
building something way more reliable, our very own income factory.
I like it. And who better to guide us through the blueprints than Stephen Bavaria himself, author of The Income Factory, an investor's guide to consistent lifetime returns?
Talk about a title that speaks for itself.
Right, gets you fired up. But
Yeah.
seriously, what I love about Bavaria's approach is that he's not obsessed with stock prices, those numbers that go up and down like a roller coaster.
He throws that whole idea out the window.
Exactly. He's all about generating that sweet, sweet cash flow and reinvesting it for the long haul.
Building a money-making machine, that's how he puts it. Just churns out cash day in and day out, whether the market's having a good day or throwing a tantrum.
And the best part, the math works out the same either way, right? 10% return is a 10% return, whether it comes from a dividend check or your tech stock going through the roof. Precisely. $100 is $100.
Love that. But this whole income factory idea, it really hinges on this concept of compounding, right? And Bavaria, he has this really cool trick up his sleeve, the rule of 72. You familiar with this one?
Oh, absolutely. It's one of those deceptively simple yet mind-blowingly powerful concepts in finance. Want to know how long it takes to double your money? Just divide 72 by your target rate of return. Boom, there you have it.
So if I'm aiming for, say, an 8% return, which Bavaria seems to think is doable, my money's going to double roughly every 9 years. That's insane.
It's the magic of compounding at work. Einstein supposedly called it the eighth wonder of the world.
I can see why. Now, I get why that long-term mindset is so crucial.
Yeah.
Okay, but here's where things get really intriguing for me. Bavaria talks about how, with the income factory, you're not betting on a company's growth like a typical stock investor. You're making a credit bet.
Exactly. It's a subtle shift, but it makes all the difference.
Okay, so walk me through this. What does a credit bet actually mean in this context?
It means you're essentially betting on a company's ability to keep those dividend checks coming, not necessarily on them becoming the next Apple or Tesla. You become more of a lender than a speculator.
Ah, that makes a lot of sense. Less focus on the daily stock market gyrations, more emphasis on that steady, reliable cash flow. But just like any savvy factory owner, we got to think about risk management. Bavaria is big on diversification, right? Not putting all our eggs in one basket.
Diversification is key. He talks about spreading your investments across different types of assets. So yeah, you've got your dividend-paying stocks, but he's also a big fan of things like utilities. Those companies that keep the lights on. People always need electricity.
Essential services.
Exactly. And then there's infrastructure, real estate. We're talking REITs here, high-yield bonds, even corporate loans.
It's like having different machines humming along in your factory, each with its own rhythm and output. Now, there's one type of investment that Bavaria seems particularly fond of, and that's closed-end funds. What is it about those that makes them such a good fit for the income factory?
Well, think of closed-end funds like buying a machine for your factory at a discount. Because they trade on the open market, their price can fluctuate, and sometimes you can snag them for less than the actual value of all the stuff they own.
Talk about a bargain. But it's not just about getting a good deal up front, right? They can also potentially supercharge those returns.
That's right. Closed-end funds can use something called leverage. Basically, it means they can borrow money to amplify their investments, and that often translates into higher potential yields for investors like us.
Now we're talking. Higher yields. Who doesn't love that? But here's where things get really interesting, and maybe a tad bit more complex. Bavaria throws out this concept of ultra-high yield strategies, specifically mentioning funds that invest in things called CLOs. Now, I'll be honest, when I first heard about CLOs, it sounded a bit intimidating, like something only Wall Street hotshots talked about.
Yeah, they've definitely got that aura of complexity around them. But at their core, CLOs, which stands for collateralized loan obligations, they're actually not that scary. Imagine a big old basket of loans all bundled together. Some of those loans are riskier than others. The income factory approach usually leans towards the less risky ones, the ones that are more about that steady cash flow than, swinging for the fences.
So it's like choosing the most reliable machines for our factory, even if they're not the flashiest or most high-tech.
You got it. Now, CLOs sometimes get a bad rap because people associate them with the 2008 financial crisis, but Bavaria actually makes the case that CLOs were kind of a scapegoat, that they got blamed for the 2008 crash a little unfairly. He actually digs into their history and turns out they've held up pretty well, even when the market's gone haywire.
Interesting. So maybe not the boogeyman everyone makes them out to be.
Bavaria stresses that, like with any investment, you have to really understand what you're getting into. Look under the hood, see what loans are in that CLO, and make sure you're comfortable with the risk level.
Due diligence is key. It's like kicking the tires before you buy a used car.
Yeah.
You want to make sure it's not going to fall apart on you.
Exactly. Now, one thing I really appreciate about the book is that Bavaria provides these different blueprints for building your income factory. He lays out these model portfolios, and they range from like pedal to the metal, let's maximize those yields, all the way to, slow and steady wins the race.
Having options is always nice. So for those investors who are a little more, shall we say, adventurous, there is the aggressive model.
Right. That one's all about cranking up the cash flow potential, really pushing the limits. But then, for the more cautious investor, there's always the conservative model.
Yeah, that one seems like it's more about protecting your capital and generating that consistent, even if it's a bit more modest income stream.
Exactly. It's like building your factory on solid ground,
Yeah.
designed to weather any storm.
Love that. Okay, but then there's this other one that caught my eye. The Income Factory Light, or IFL, as the cool kids call it. This one's kind of like the hybrid model, right? A little bit of this, a little bit of that.
Exactly. The AFL blends that high-yield approach of the income factory with a more traditional dividend growth strategy. You're still capturing that consistent cash flow, but you're also leaving some room for potential growth down the line.
The best of both worlds. I like it. It's amazing how Bavaria has really thought of everything. He even addresses how this approach can actually shine even brighter when the market's flat or, get this, even taking a dip. Seems a little counterintuitive, doesn't it?
It does. But the logic is actually pretty simple. When stock prices drop, right, and you're consistently reinvesting those dividends and distributions, you're essentially buying more shares at a discount. It's like getting a sale on those factory parts.
That's what I'm talking about. Bargain hunting at its finest. Almost makes me want the market to crash. Almost. But speaking of things that seem counterintuitive, there's this idea in traditional investing that a really high dividend yield can actually be a red flag. How does that play out with the income factory approach?
Yeah, that's a great point. You're right. In the world of stock picking, a sky-high dividend yield can sometimes be a sign that something's fishy, right? Like maybe the company's struggling, the stock price is tanking, or a dividend cut might be on the horizon. But Bavaria says that this rule of thumb doesn't always apply, especially when you're diversifying across different asset classes like he advocates.
So it's all about context.
Exactly. A high yield in one area might be totally normal, while in another, it's like sirens are going off.
Got it. Makes sense. So for example, those REITs we talked about, utilities, those high-yield bonds, even CLOs, they just naturally tend to have higher yields than, say, your typical blue-chip stock. That's not a bad thing. It's just part of how they work.
Precisely. It's like knowing the personality of each machine in your factory, Some are just naturally louder than others.
I like that analogy. Okay, so let's get a little bit more hands-on here. Bavaria gives us this whole buffet of specific funds that we could use to actually build this income factory, right?
He does. He breaks them down into categories, makes it really easy to digest. You've got your equity funds, which are mostly stocks, fixed income funds, those are your bonds and loans, and then multi-asset funds, which, as the name suggests, can hold a little bit of everything.
Variety is the spice of life and of a well-diversified income factory, I guess. So let's dive into some of those specific fund types that he mentions. What are some of the ones in the equity category that really stand out to you?
Well, he's definitely a fan of those classic dividend-paying stocks, but he encourages investors to think a little bit outside the box, Go beyond just the big household names. He highlights utilities and infrastructure companies because, well, like we were saying earlier, they provide those essential services. People always need power, water, transportation. Those income streams tend to be a lot more stable. And then, of course, REITs, those real estate investment trusts, they're great for generating that steady rental income.
It's like owning a whole empire of rental properties, but without all the headaches of being a landlord.
Exactly. And you've got that built-in diversification with REITs, too. You can invest in apartment buildings, shopping malls, office spaces, you name it.
Yeah, bonds. I got to be honest, they sometimes feel a little bit like the boring cousin at the investment party. But Bavaria seems to think they definitely have a place in the income factory.
Oh, absolutely. Bonds are like the reliable workhorse of the portfolio. But he's not talking about your typical run-of-the-mill bonds, the kind you might find in your grandma's retirement account. He's more interested in those high-yield bonds, the ones that offer a little bit more, shall we say, excitement?
A little more pep in their step.
Exactly. And remember those senior loans we were talking about earlier? He's a big fan of those too. Those offer a nice balance between risk and return.
Less risk than stocks, but still with the potential for those juicy yields.
Okay, and then we have those multi-asset funds. Those are kind of like the all-stars of the income factory world, right? They sound like a bit of a set-it-and-forget-it option, at least compared to some of these other investments. They can be.
Yeah.
And they offer that built-in diversification that Bavaria is always talking about. He mentions a few really interesting ones, like funds that focus on convertible bonds. Those are kind of cool. They start as bonds, but can actually transform into stocks. Then you've got funds that hold real tangible assets like infrastructure projects, natural resources, things like that. And then there are even those go anywhere funds. They give the fund managers a lot of flexibility to invest across all sorts of different asset classes, depending on what they think looks promising.
Sounds like those fund managers have a pretty sweet gig. They get to scout out the best deals and, shift gears if things start to change. But so far, we've been talking about this as if all our listeners have these tax-advantaged accounts like IRAs. What about those of us who are investing in a taxable account? Does this whole income factory thing still work?
That's a really important question, and I'm glad you brought it up. And yeah, Bavaria addresses that head on. He points out that even within a taxable account, you can still build a really tax-efficient income factory. It just might take a bit more planning and strategizing.
So like choosing different types of machines for your factory that are better suited for that taxable environment.
Exactly. He specifically mentions funds that hold a lot of qualified dividend-paying stocks. Those can be much more tax-friendly, even outside of a traditional retirement account.
Got it. So you can still benefit from this approach, even if Uncle Sam wants his cut. One thing that really struck me about Bavaria's philosophy is his view on risk. He doesn't shy away from it. In fact, he actually encourages readers to get to know the different flavors of risk and then decide which ones they're cool with inviting to the party.
Absolutely. He doesn't see all risks as being created equal. For example, he talks about liquidity risk.
Liquidity risk. Okay, so that sounds a little bit like, getting stuck in investment quicksand.
It's more like just being aware that some investments are easier to sell quickly than others.
Okay, so being comfortable with a little bit of illiquidity.
Exactly.
But what's the upside there? Why would I want that risk in my portfolio?
Well, often those investments that are a little harder to sell, they come with higher potential yields. Fewer sellers, more demand, prices go up, yields get juicier. It's that old supply and demand dance.
So it's like scoring a deal because other investors are too impatient. I can get behind that. What other types of risk does Bavaria encourage us to embrace?
He also talks about complexity risk, which, pretty self-explanatory, means some investments are just more difficult to understand. CLOs, for instance, definitely fall into that category.
And those more complex investments, those often come with a bit of a yield premium too, right? Because not everyone's willing to put in the time to really wrap their heads around them.
You got it. It's like finding those hidden gems in the investment world, the ones that require a little more digging but could potentially pay off big time. But remember, Bavaria is all about due diligence. He's not saying jump into the deep end without understanding what you're getting into.
It's about being an informed factory owner,
Mm-hmm.
not just someone who gambles on anything with a high yield. Knowledge is power. All right.
100%.
Well, we've covered a ton of ground today. We've explored this whole income factory concept, talked about those CLOs, and even touched on those different types of risk we might come across.
It's been quite a journey.
It really has. And what I find so compelling about this whole approach is that it really shifts your perspective on investing. It's not about watching those stock tickers every second of the day and riding that emotional roller coaster. It's about building a system that generates consistent cash flow, no matter what the market's doing. It's almost like finding a sense of calm in the middle of a storm.
That's a great way to put it. It's about tuning out that noise and focusing on what truly matters. Building that sustainable income stream that can support your life no matter what curveballs come your way.
It's like that saying, slow and steady wins the race. Or, in our case, slow and steady builds the ultimate income factory.
I love it.
Well said. This has been an awesome deep dive. We explored Bavaria's income factory, dug into some interesting investment ideas, and maybe even challenged our thinking about risk a little bit. But now, dear listener, we're going to leave you with a final thought-provoking question. If, as Bavaria argues, this way of investing can lead to a more grounded, less emotional experience, What other indicators of true value might we be overlooking in our own pursuit of financial well-being? Something to think about as you build your own income factory. That's all the time we have for today's deep dive. Join us next time as we continue to explore the world's most fascinating ideas.